Breaking news, those FOMC minutes are out now. Our economics editor Michael McKee has a copy. He joins me now to break it down for us. Michael?
Well, Mark, we didn't expect news from the minutes after Ben Bernanke's press conference, but we got some. We don't know when, but we now know how the Fed will exit from its extraordinarily low monetary policy. After a lengthy discussion of their policy strategy options, Fed officials have agreed on principles to guide the normalization of policy. The first principle, raise rates first, then drain the balance sheet. A majority of participants preferred that sales of agency securities come after the first increase in the FOMC's target for short-term interest rates, the minutes say. That would give the Fed the option to cut rates if the economy went back down again and it was necessary. It would also, they said, limit speculation in the markets that could lead to bubbles. Now, this tells us, again, nothing about the timing. They took care to note they were discussing their strategy. It did not mean a move would be, in their words, necessarily beginning soon. Well, many of the participants also expressed a preference that when they did start selling, that sales proceed relatively gradually, returning the system open market accounts composition to all Treasury securities over perhaps 5 years. The Fed has traditionally held Treasury securities only. Most participants saw changes in the target for the federal funds rate, meanwhile, as the preferred active tool for tightening monetary policy when appropriate. In other words, when it's over with, they're going to use the Fed funds rate. The discount rate would be a ceiling for rates. The Fed funds rate would trade in a corridor in the middle of the range, and the interest on excess reserves the Fed is now paying would be the floor for that policy. As for the minutes themselves and what they saw going on in the economy, well, the economic recovery was proceeding at a moderate pace, they said, albeit somewhat slower than had been anticipated earlier in the year. Many participants, though, had become more concerned about the upside risks to the inflation outlook. Economic conditions, some of them said, might well evolve in a way that would warrant the committee taking steps toward less accommodative monetary policy sooner than currently anticipated. So at this point, they remain divided over the when, but they do seem to have come to general agreement, a majority at least, on how they're going to get out of where they're at. Mark?
Michael McKee. Michael, stand by, because right now, for more on the FOMC minutes, let's bring in Diane Swonk, chief economist for Mesirow Financial Holdings and a former advisor to the Federal Reserve Board. She joins us from Chicago. Diane, always a pleasure to have you on Bottom Line. Thanks for joining us.
My pleasure.
Diane, you just heard Michael McKee's report, and as he mentioned, I guess some news made today, the Fed saying the first principle, raise rates first, then drain the balance sheet. Let's get your reaction to that.
Well, I think this really underscores something that people had been arguing that I argued against. So I feel a little vindicated here, is that all of a sudden the minutes would mean less, and they actually do still have a lot of news in it, because Ben Bernanke, when he does the press conferences, he has to represent the consensus and one sort of centric view of the Fed. And we know that in these ambiguous times, we also saw the spectrum of views widened a little bit. And you would expect people, as they're coming through the minutes, knowing that Ben Bernanke's out there doing a press conference, they'd want to reflect in the minutes a little stronger their views and the differences between views in terms of when you tighten, how bullish they are on the economy, all that in terms of has widened in recent months, and I think that's important as well. I also think it is a very important thing. Talking to the Fed, you do hear from the Fed that they didn't think there had to drain their balance sheet before they raised rates. I didn't hear Mike say anything about the reinvestment policy. That's keeping the balance sheet constant. But that idea that they didn't have to sell assets, many people in the market were confused about that, and I think that's an important clarification that came through in the minutes.
Well, Diane, they did say that that would probably be the reinvestment, ending reinvestment would probably be the first step that they would take, perhaps some language
Which
changes.
Makes sense.
But of course, that is only a very mild form of tightening, that they would follow that fairly quickly by a Fed funds increase. What do you think of the idea of using the corridor system that they talk about? That most people thought they would be focused on interest on excess reserves. Instead, a majority seem to want to use the Fed funds rate.
You know, I think there's really a resistance to go off of that the Fed funds rate. They want to keep the Fed funds rate, and even though they've had trouble with the Fed funds rate and hitting their target, clearly that's a tradition they want to keep up, and they think that as things normalize, that will be easier to hit. So I think it's a sense of let's not change everything and throw the baby out with the bathwater. And that is, again, another important issue, is that they're saying the target on the interest rate on reserves is not going to be the target we use. They really clarified quite a bit from these minutes, and again, it shows the important role that the minutes can still play in clarifying the details of the policy that there's no way Ben Bernanke can completely communicate at a press conference.
And Diane, there was that conversation about inflation. It says that another few members, few in quotes here, saw, quoting here, the increase in inflation risks as suggested that the economic conditions might well evolve in a way that would warrant the committee taking steps toward less accommodative policy sooner than currently anticipated.
And I think that's really important. This is those hawks voicing their voice a little louder, given that they had that press conference. And those hawks are out there saying, listen, we didn't vote against it. We're standing with Ben Bernanke. We're not, Tom Hennig's not on voting right now. And these guys have been very strong. They've been out there with their words, but they've been voting unanimously to support Ben. I think sort of the Fed circling the wagons as Congress takes attacks at them and potshots at them. But I do think this is really important. You're going to hear this is, if anything, these kinds of things. People thought that Ben would sort of get a more prominent role. Well, on the other side of it, it's really hard to silence these independent voices out in the president's, and you're going to just hear more loud noise coming from it.
Yeah, we're going to hear, Diane, a very interesting speech tonight from Jim Bullard, who was on Bloomberg Television earlier today. He's going to argue that the Fed should stop looking at core inflation and focus on headline inflation like the ECB and the Bank of England do. Here's a little bit of what he said earlier today.
You can get into a trap by overemphasizing core inflation, and then you sort of get lulled into thinking that these other prices don't matter, but they do matter for the economy, and these are the prices people are actually paying.
Now, is that, do you think, Diane, just a reflection of the fact that he comes from the monetarist tradition of the St. Louis Fed, or is there a real move to get away from the core rate and to reflect what people are actually paying and feeling out there?
Well, the core rate was always only used as a mechanism because it tended to be a good forecaster of what the overall rate should be. Almost anyone you ask on the Fed and anyone I've ever talked to, they said, ultimately, we're targeting, in the medium term, overall inflation. We're not targeting core inflation. And I think the Fed, on a credibility basis, really needs to get that language out there. And so Jim is playing an important role in getting the message out. Also, in the last meeting, the last Fed Minutes meeting, there was a lot of talk about sympathy for a Fed target, an explicit Fed inflation target. And again, that would be the overall target of inflation, not the core. And I think, there's a lot of misunderstanding in the marketplace. And this is trying to clarify that ultimately, at the end of the day, the Fed cares about inflation. It's not just core inflation. They really do care about the overall inflation we're feeling.
Well, Diane, with June soon upon us in just a couple of weeks, then the Fed is on target, on time to wind down that $600 billion of purchases?
They're going to wind down their $600 billion. I think they'll keep the reinvestment program going throughout the summer. And then my view is that they'll pull back on the reinvestment program. As Mike noted, it'll be the first step in tightening. But the drain off, really easy to give to the hawks because the drain on the Fed's balance sheet is not like it was last August. People aren't refinancing their mortgages. It's going to be very slow. So it won't represent a major tightening, but it will sort of be a prelude to that raise in rates. I think that's going to be in early 2012.
I was going to ask you, Jim Bullard said today could come before the end of the year, but your timing would be 2012 for a rate increase?
I think it's 2012. I think we're still going to have enough murky of an economic situation. We do have a lot of things that are, all of a sudden we're ratcheting down second quarter growth. A lot of it transitory, Japan-related, production interruptions. But how many transitory hits can we get before we start saying, well, when is the year going to be not as good a year as we thought? And we've all ratcheted down our forecast a bit for the year. And so I think that keeps it within the Fed, sort of keeps the hawks at bay a little bit. I think the timing, beginning of 2012, whether it's the end of 2012, beginning of 2012, that's really splitting hairs, to be honest with you, in terms of its impact on the economy, although I know a lot of traders who would disagree with me.
Diane Swonk, chief economist, Mesirow Financial, joining us from Chicago, and our economics editor, Michael McKee. Thank you both so much. Appreciate it.